And let's drill down a bit more into all of that with Viktor Katona, lead crude analyst at Kpler. He joins us now from Vienna. Thank you very much indeed. Good to see you, Viktor. So can I first ask you, what impact will the G7 coalition's agreement to set a fixed price for Russian oil when they finalise a price cap, what effect will that have on the market, do you think? And where else can countries look to for supply?
Well, it's definitely going to be a disruption. The real question is whether the disruption that's going to come is going to be temporary, i.e. happening over the winter season, or it's going to be longer and extend well into 2023. We believe that it's going to be a relatively temporary. Trading has already been disrupted into China and India because those countries have long-haul voyages. They still don't know what the price cap is, and lacking the details, most countries' natural reflex, even if they are buying or have been buying Russian crude in the past months, would be to wait it out and to actually see what the oil price cap is. Right now, what we still don't know, what exact level will it be? How strong compliance, how stringent will it be? Effectively, those countries will wait. But in the long term, we expect that whoever is buying in Asia, the big buyers, will continue buying Russian crude even in 2023, even in 2024, primarily because the discounts are just too good for them not to latch on to.
And Viktor, as I was saying just before I came to you, crude prices are set for weekly gains. What underlying pressures are you most concerned about?
Well, I think the market in general is very much concerned about recession. How is it going to pan out? Will the Fed and will central banks all around the planet actually manage to curb inflation? Because right now we have this Manichaean sort of situation when the winter months are really strong. December 2022 is going to see the highest level of demand in 2022. Asia is going to be strong. Europe is going to be strong. America is going to be strong. Effectively all around the globe, it's still very, very strong. But we expect pain to kick in at some point in the future. And that is a very palpable, very, very tangible threat. And if you see the interaction that we have been seeing in the oil prices, it's very much a situation of undersupply. OPEC saying that, hey guys, we care about the price. We want to manage the price so that it's palatable. And all the macroeconomical sort of doom and gloom which surrounds us, it's inevitable. It's across the board for everyone. And that interaction has basically kept oil prices within very much range bound since October the 4th. So for the past month, prices have been within the $900 to $100 per barrel bandwidth. They just move within that. So it's very much a tie so far between the two.
And Viktor, picking up on OPEC there, what are the heavyweights at? Where are they at when it comes to production targets?
Well, they are acting out what they have promised. If we look into October, the month which we already have full data for, we already see that Saudi Arabia and the United Arab Emirates have been cutting exports. They are exporting less. They're exporting less with less inventories at home, from which we can actually assume that there's less production. So they have already acted upon what their own promises. And this is all without even Russia kicking in. Once Russia kicks in and we feel the decrease in Russian flows into the global markets, then actually we'll realize to what an extent the market is managed in terms of supply. So one could argue that the undersupply of the markets from OPEC Plus is a dubious decision in times of very, very high demand. If we look at the end result and the end result of the prices, they have reached exactly what they wanted, and it was a very, very efficient job.
Viktor, we'll have to leave it there. Thank you very much indeed. Viktor Katona, lead crude analyst at Kpler. Good to see you.